let's get back to CPI because we have more inflation data coming out tomorrow with that consumer price index, giving us a key piece of economic data ahead of the Fed's interest rate decision next week. For more on the state of the U.S. economy, not just for the rest of the year, but beyond, let's welcome in Torsten Sløk, Chief Economist at Apollo Global Management. And of course, we should mention Apollo is also the parent company of Yahoo Finance. Torsten, always great to see you. Let's focus in the near term, and then we'll get to the longer term. Let's talk about CPI tomorrow, what you're expecting, and kind of what the implications are then for the Fed.
Yeah, the big picture here is that CPI peaked in 2022 at 9%. Now it's come down to 3%. And the Fed's target for where we're going is 2%. So we got from 9 to 3. And the big question, of course, is 3 enough, or do we need to get further down? The Fed has obviously started cutting rates. And as you just talked about, I agree that they will cut rates again next week. But the big question is with the CPI tomorrow that, well, there is some evidence in the last few months that inflation is beginning to move up again. And that's throwing a bit of a wrench into the narrative from the Fed, because that might imply that we're not going to get as many Fed cuts over the next 12 months as the Fed has been saying. So the short version of what's going on, in my view, is that inflation has come down a lot, but it's not quite there yet. And now the question is what the Fed needs to do, in particular with the economy still strong and some risk to the upside to inflation from tariffs, some risk to the upside to inflation from restrictions on immigration, and potentially also some upside risk coming from lower taxes.
As you said, Torsten, inflation has moderated, but as you point out, it's not where Jay Powell wants it to be. Can you try and model out, Torsten, when you do think inflation gets back to that 2% target and importantly stays there?
Yeah, that's very important, Josh, because the key question then becomes, well, what does the Fed need to do today to get inflation back to 2%? And our strong opinion at the moment is that they need to keep interest rates higher for longer. In other words, in bond markets, we will see front-end yields be more elevated than what markets are pricing as we speak. In other words, we only anticipate that they will cut next week, but then we also anticipate that they will skip in January, because now they need interest rates to stay higher in order to slow the economy down enough to begin to get inflation down to 2%. So that means that for private credit, for fixed income more broadly, yield levels will still remain elevated for at least the next several quarters in our view.
I guess the question is, and you basically raised this question in your outlook for 2025, is what is the Fed's effectiveness at this point? And one of the ways to illustrate that is simply by looking at a chart of GDP growth since the Fed began raising rates, and which in theory should have then slowed GDP and slowed inflation much closer to its target. And yet GDP has been stubbornly good, right? So I guess the question is, what good is the Fed at this point? How effective are they?
Absolutely. Look at the chart that you're showing here. GDP growth has been remarkably resilient since the Fed began to raise interest rates in March of 2022. In other words, this chart here is the reason why the S&P 500 has done so well. This chart is the reason why credit spreads continue to trade very tight, because the economy continues to do remarkably well. Why is the economy doing so well? Well, first of all, because during the pandemic, consumers and firms locked in low interest rates. Remember, in the US, 95% of mortgages are 30-year fixed rate. That means that when the Fed raises rates, it does not have much impact on homeowners. That's a dramatic difference, for example, to the UK, where when the Bank of England raises interest rates, it immediately has an impact on mortgage payments for homeowners. Likewise, in the US, we also have had a very strong data center boom. We've had a strong AI boom. And we also in the US have still, even before we know what Trump will do, still have strong effects of the CHIPS Act, the Inflation Reduction Act, and the Infrastructure Act. And all these three effects have been very strong tailwinds that are the key reasons, to your point, Julie, of why the economy continues to do so well, and therefore why the Fed does not need to cut interest rates as much as they thought just 6 months ago. When
you look ahead, Torsten, you see this U.S. economy that's resilient, it's chugging along. What, when you talk to your clients, do you outline as sort of downside risks for that?
Yeah, this becomes very important, because I do think that tomorrow's number that we're getting on the CPI is very important, because if inflation tomorrow is a little bit higher, and the consensus is actually expecting both on core and on headline a little bit higher number, that runs the major risk, of course, that we in 2025 bring back the environment we had in 2022. Remember, as we all know, in 2022, interest rates went up and stocks went down. That meant that the 60-40 portfolio in 2022 underperformed dramatically. And the fear that one can have going into 2025 is that if inflation does go up again, and therefore interest rates begin to go up again, then of course the stock market will begin to sell off. And again, in that case, the 60-40 portfolio will not be doing very well. So we really mainly worry about whether inflation tomorrow will continue to show this steady uptrend that we've seen in the last 2 months.
One thing we've been talking about monetary policy, we haven't really talked about fiscal policy, Torsten, and obviously there's a lot to consider from tariffs to regulation to tax cuts. What is sort of your base case? And on that last point, when it comes to tax cuts, do you think we will see not only an extension, but more tax cuts, deeper tax cuts coming in the next year?
No, that's right, Julia. And this is really where we don't really know much at this stage, but we do know that the Trump tax cuts will run out, meaning the tax cuts that got implemented in 2017 will run out on the 31st of December in 2025. Remember, as we all know, in 2017, you saw corporate taxes come down from 36 to 21%. You saw household taxes come down from 39.6 to 37%. So both household taxes were lowered and corporate taxes were lowered. So the result of that is that something needs to be done on continuing the Trump tax cuts, or at least some version, unless we will get some significant slowdown in the economy. Other things, of course, that Trump has talked about on the campaign trail, he's talked about lowering corporate taxes for domestic manufacturers to 15%. So that's giving an additional tax cut to companies that produce domestically. So if that does come around, that will also be a tailwind to economic growth, which will add to the chart that we just looked at, namely GDP growth already being strong, and therefore add a tailwind to the economic outlook.
So when we talk about Trump, Torsten, we talk taxes and deregulation. Of course, we also have to talk about tariffs, which is difficult, I would imagine, for an economist like you to model, because you're trying to figure out how much, what actually will be the policy. How much is this is just negotiating tactic, negotiating strategy. But when your clients ask you, Torsten, about potential tariffs and its impact on the economy, what do you tell them?
Yeah, no, this is very important also, Josh, because what we do know, at least, of the three things that Trump has talked about, namely talked about not only tariffs, but also restrictions on immigration and also on lower tax rates for corporate manufacturers. All these three effects happen to have a lifting effect on inflation. So the conclusion and the issue, at least in terms of how one can look at what might be coming next year, is that if the main three areas where new policies might be coming is lower taxes, more tariffs, restrictions on immigration, it happens to be the case that the textbook would be predicting that all those things should be putting upward pressure on inflation. So if we already have, as we started out talking about, inflation still only at 3, not quite down at 2, and showing an uptrend in the last few months, then adding to that the risk that there might be some more modest upside pressure to inflation, that does, again, bring you to the conclusion that interest rates will stay higher for longer. As you can see in the chart you are showing here, we have seen in the white line inflation tick up a little bit more recently, and that is exactly the worry that is why the Fed probably will keep interest rates more elevated than, again, what the market is currently expecting. And that, again, means bonds and fixed income giving yields that are higher than what people are currently anticipating.
And Torsten, in addition to fiscal, in addition to monetary, one of the long-term trends that we've talked about all year has been the rise of AI. And I thought the point that you made in your note was quite interesting on this front, which is that you think that the U.S. is pretty far ahead of most developed markets when it comes to data center build-out and AI. Are we going to retain that lead, and how important is that then for our economic growth?
Yeah, this is really important. Have a look at this chart you are showing exactly here, that at the moment there is more data centers in the US than all other countries in the world combined. It tells you that there is a significant need for capital for long-term investments. Of course, in AI and data centers is one very obvious place, but across the board in energy transition, we also have the Inflation Reduction Act, we have the CHIPS Act. We might now have more, again, on the manufacturing front. Just today, Trump announced that anyone who invests more than $1 billion in the US, of course, will be very welcome. So there are very significant tailwinds to long-term capital projects, and therefore financing from companies to long-term projects over the next 20, 30 years to transform the US economy, not only on the AI and data center front, but also on the energy transition. That is what we and others have called, of course, and talked about as the industrial renaissance that needs financing and needs capital. And that requires long-term financing, long-term capital to get exactly more data centers and more investment in the US.
Torsten, a final question here. If I was a viewer and I was listening, and I think, you know what, Torsten makes a lot of sense. I think we're higher for longer. What are some of the implications for the stock market, Torsten? You know, because if I believe that we're going to be higher for longer, do I avoid small caps, for example, Torsten?
Yeah, exactly. So let's add up all this to what it means for the stock market. So importantly, the challenge for the S&P 500 at the moment is that it's so highly concentrated. Roughly a third of the index is made up of the top 10 companies in the S&P 500. We all know how important Nvidia is and how critical it has been for returns this year. The problem for the small caps is that 40% of the Russell 2000 have no earnings. So that means that if rates are higher for longer, that means that small cap companies will continue to struggle with earnings and therefore not being able to service the debt servicing costs. So that brings you to the conclusion that if you have to be in public equities, the mid cap or S&P 400 still continues to look like the most interesting place to be, simply because the risk is too high when it comes to the large cap companies, because it's so focused on a handful of names. And for the small cap companies, again, in my view, the bubble in small cap is still growing and continues to be significant when you take into account the fact that, again, 40% of companies in the Russell 2000 have no earnings. So in public markets, sticking with the mid-cap companies is perhaps the best strategy. But when it comes to general asset allocation, rates higher for longer, of course, means that you could be cutting coupons in fixed income that can still, including in private credit, still give you some very interesting yields. So let me summarize that by saying I love the adrenaline rush from looking at Nvidia and looking at a Wednesday afternoon where they deliver on earnings, will they not deliver on earnings. But why don't I sleep well at night and get some nice cash flows that are treating, of course, investors very well, given where yields are and given rates are going to be higher for longer.
So you can have your adrenaline rush and still sleep at night. I like it, Torsten. I like it. All right, it's great to see you. Thank you so much for joining us.
Thank you.